How y'all doing, bro? So today I'm making a video. Um, if I were to start completely over from day trading, what would I learn first, and what is the order in which I would learn pretty much everything, like the rest of it, right? So if you see me looking up, I'm just referring to some notes that I wrote down, basically listing it all out. So let's get into the video. So if I were to start completely over, uh, first thing before we even get into the list, you would want to think about, you want to know, set your expectations to be something realistic, right? It's gonna take a good minute to learn this, and it's a skill that you're always growing and you're always becoming better at. You feel me? There's always something you could fine tune to be better, or even if you have it completely straight, you still have to consistently work on yourself to better your psychology. So regardless, trading is a lifelong thing, lifelong learning, lifelong potential. Say for instance, you're in one phase of your life where you're an intraday trader, and then you enter another phase when you become like more of a business person. You have businesses and other things like that. You have other things to focus on, and you have to be able to trade less. You have to learn a whole new style of trading. You have to adjust to becoming a position trader. So as like you see, like I'm saying, everything is, all tied together. All right. So first thing, I would start off learning about the market sessions. I feel like the market sessions is the basic to becoming a trader. Like you have to know the market sessions. You have to know New York session, London, the overlap, Sydney session, Tokyo. You need to know the sessions, the tendencies and characteristics of them. And that will literally set you up on your journey for what you need. You'll know London is the most volatile. So guess what? You need to know the sessions, because the sessions will go into which type of trader you are. If you're a scalper, you're obviously going to be trying to trade London session, because London has the most volatility out of all the sessions. New York is, some say New York, but through my trading, I've seen London has the most, you know what I'm saying? But you have London session, you have the New York overlap. So that overlap and London, I believe, are the most volatile sessions. So you need to be able to know that, you know what I'm saying? You need to have that information in your repertoire of knowing what you're going to do. If you're looking for something, a session where stuff trends or moves a lot, then you're obviously going to be looking to trade New York session. That's where you get your trends. That's where you get your direction for the rest of the day. You get your reversal for the rest of the day. Things like that. That's New York session. So if you're more of like I just want an intraday trade, I always want one straightforward trade, you will be looking intraday wise at New York session. If you're somebody that's trying to trade more of a range bound market, or you have a range bound strategy, you'll be obviously looking to trade Tokyo or Asian session. Asian session, being Sydney and Tokyo. You'll be looking to trade those sessions because it's less outrageous moves. It's more of a range bound market during that time. So if you have a strategy that involves a lot of support and resistance, supply and demand, or you like working with little ranges, you would know to trade those sessions. So that's why I would start with the market sessions, because that sets you off on the journey of learning everything else, right? All right, after you learn your session, you've studied your session, you got in all you need out of knowing your session, I would say next is to learn market structure and the phases in the market. That is the basics of every strategy. Market structure. Phases in the market, they're very important to know, like accumulation, distribution, manipulation, like the market structure phases like that, the reaccumulations, you know what I'm saying, where those things take place, how those things happen, where they line up in a trend, where they occur in a reversal, like those type of things, like the phases, right? Then you got the actual market structure. So you got, market structure shifts, breaking retest, trends, range bound markets, things like that. So you need to know market structure, trend lines, all that good stuff. You need to know market structure. Market structure also includes candlestick patterns. If you trade more retail style than pattern formations, like I was saying, trend lines. If you trade trend lines, things like that. No matter how you use market structure is involved in every single strategy. Every strategy with the 60, 70, 80% win rate, every high win rate strategy has market structure because market structure is indisputable. You can't do nothing against market structure. Market structure will tell you everything you need. So you need market structure. Once you have a strong foundation of learning market structure, you could pretty much trade any pair. Because you have to, once you get to know the pair, you have to know how their structure works. But structure is the basic of every pair. All right. Next is learn and test different styles. So from here on, now we're getting more advanced. So this involves learning a style of trading, or not really learning, I would say, but like getting familiar, I should say, with each style of trading. So intraday, scalping, and position trading, and seeing which one suits you the best as a trader. Like, what are you looking to do? Are you looking to be somebody that's, oh yeah, I get pumped up, I get motivated when I'm sitting on the sidelines, I feel like I'm not doing anything, I need to be in the markets, you know what I'm saying, really to really have that fulfillment that I'm working? You're more of a scalper. If you're somebody that's like, okay, I like to trade, I have to trade every single day, but I like to trade, at least like most of the week. You feel me? Like I would like to I would take a trade here, or at least every other day. Intraday trader. I'm looking to trade like once every like 2 weeks, once a month, stuff like that. Position trader. You know what I'm saying? And then anything longer than that's like a long-term investor, right? So you want to kind of know like what those type of styles entail, because once you have your market session and you understand market structure, and now you kind of figure out what suits you as a style, that's when you can start actually finding strategies that that accommodate you. You can find strategies that actually cater to what you are as a person and the style of trading that you aspire to be, right? So that's why you need to know to test the styles or get familiar with them, to be able to see which category you fall into, to even be able to start testing out strategies and knowing strategies and stuff like that. Next thing I would say is learn and choose pairs. So you want to have at least, I have 4 pairs, but that's because they're inversely correlated. I did have 2 pairs, but yeah, 2 to 4. You're gonna have 2 to 4 pairs. People say you should have 1 pair. I mean, I've never in my whole trading journey had 1 pair, because if my setup doesn't happen on this pair, it happens on this one. Or if it doesn't happen on those 2 that are correlated, then they're out the picture and these 2 happen. But I usually love 4 pairs, because 3 to 4 pairs gives you enough information to make good trades, right? Like say for instance, you're thinking, I think I should buy on gold and silver. Like I'm thinking I should buy on those 2 pairs. But NAS 100 and US 30 are going up. Then you're kind of like, okay, wait, maybe I got this all wrong. You'll wait to see what either side is going to do, because they're inversely correlated. Like gold and silver, I find when they sell, NAS and US 30 are shooting up, and vice versa, right? So if I see them both buying, I'm gonna wait. If I see them both selling, I'm gonna wait. If I see this side both buying, and these are showing me selling indications that line up with my setup, I'm gonna sell these 2. See what I'm saying? So that's why I like to have 4 pairs, right? So I like pairs that inversely correlate, because it'll give me what I need for the other pair. Like, what's another pair that inversely correlates? Like the DXY and gold, right? If you see the DXY going up, you should see gold going down. If they both are going up, you should do nothing. If they both sell, you should do nothing. You should just that means something unprecedented and volatile is happening. Just wait. You feel me? So that's why I think your pairs are important. I always tell people to pick pairs that inversely correlate. Because say you're kind of iffy on your trade, but this pair has strong buying indications. And you're like, oh, I'm not gonna be so iffy now that I have extra confirmation. You know what I'm saying? You always have that extra confirmation in your back pocket to support what you're doing. So I always tell people, choose pairs that inversely correlate, and you want like around 4 pairs. That won't have you chasing trades. That won't have you like feeling uninvolved, all that good stuff. Because if nothing happens on any pair, then that's a day you shouldn't trade. That you just shouldn't trade. If nothing's happening on any of your 4 pairs, just leave it alone. Just come back the next day. Because on one of those 4 pairs, you're usually going to get a trade, which is why I say you should have like 4 pairs. All right, moving on. So after you choose your pairs, the next thing you should do is sharpen your psychology and learn your risk management. So your psychology is just basically your thought process of a trader. You should basically just watch psychology videos, or, you know what I'm saying, learn from traders that are profitable what to and what not to do. For example, like, you shouldn't revenge trade. You shouldn't keep trading if you've reached a certain amount of losses or a certain percentage of your account, like things like that. Like, just focus on your psychology, when to move your stop to break even, when to let trades run and take partials, all that good stuff. That's all psychology and risk management. Risk management is the most important part of trading. Your strategy can be terrible. You can have a terrible strat. I've seen it. I've seen some people have 30% win rates, but they're up 10 bands. You know why? Because of their risk management. If the trade doesn't run their way, they have an aggressive strategy of risk management. As soon as the trade goes in their direction, they could get in the trade, and the trade always goes in their direction because they always got, it's like a momentum-based strategy or something, right? Impulse-based strategy. They'll move their stop to break even. If price comes back down, they're out. So they'll take like 50 trades, 30 of them will be break even, and then 20 of them will be winners. And so technically they've lost a bunch of trades, but their books are showing profitability. Stuff like that. Like, you can have a terrible strategy and your win rate, say, like if you have a 50% win rate, but you trade 1 to 3s, you're profitable. 1 to 4s, you're profitable. 1 to 5s, you're profitable, right? Even a 1 to 2, you're gonna be profitable. That's why it's like risk management is so important. If you have a strategy and you always aim for a 1 to 3, of course, backtest and make sure that your strategy is even capable of supplying that for you. But if you can do that, you're good. You feel me? So risk management is like one of the most important things, because your win rate could be it could be terrible, but you're so good at managing risk that it just doesn't affect your financials. You're right. So sharpen that, learn risk management. All right. And then after you've done all of those things, and see, this is what I'm saying, trading takes a minute to learn, because you have to go through all that to finally get to this part, the big picture, which is what I literally wrote. By now, you should have a feel for what works. Double down on what works and what confluences are the most clear to you. Are the most clear to you, right? So literally, by that point, you should know what your confluences are that you like and what you don't like. So for instance, say you don't research strategies. I always tell people, just when they first start, after you get past that first initial part, just research strategies, bro. Because you'll find some stuff you'll like. Like, you might like liquidity sweep strategies, right? That's how I got a strategy I like liquidity sweep. I see a lot of impulsive moves off of liquidity sweeps. Inverse fair value gap, I've seen have like an 80 to 90% win rate. I'm like, yo, I like that. That's an easy thing to spot. That's an easy thing to put in confluence with my other reversals of market structure shifts and stuff that easily, seamlessly fits into the strategy I already have. There's nothing wrong with that. I like that right there. So when it gets to that point, you should be able to set aside what confluences you like and what confluences you don't like, but revamp those to where your strategy still has a 3 confluence thing. You know what I'm saying? Like you should always have 3 confluences. You should always have 3 things on your checklist before you get into a trade. That's the good number is 3, right? Now if you have 4 or 5, that's okay, but you don't want a strategy with too many confluences, because they'll filter out all your trades. Because the scenario of all of that stuff, the possibility of all that stuff happening is it gets lower and lower the more confluences you add. So you want to try and keep it around 3 confluences, but you want it to be 3 strong confluences, right? So that's another rule of thumb that you should do when it comes to that is you want confluences. You want 3 to 4, but you want them to be strong so where you don't have to have so many. Because if you have too many, you'll over filter your strategy, and you won't get any setups at all. You'll be just sitting on sideline for weeks because all the chances of all this stuff happening are very low. All right, that's gonna mess with your psyche, and then you're gonna take a day off from trading. And that day that you took off is the day that the strategy hit. So it's just like you're gonna be frustrated. So it's just like, yeah, just don't over filter your trade setups. All right. Next is tweak and revise things that don't work. So if you realize you like these confluences, but they're not working with this particular strategy, you can either look up a strategy that uses the confluences that you like, keep the strategy and tweak the confluences to other confluences that you like, or completely just revamp the whole thing. You feel me? Strategy hopping is when you just go from strategy to strategy to strategy to strategy. Tweaking your strategy is where you just like you keep the same strategy, but you kind of tweak it. Like, for instance, if you're an ICT trader, he has a whole bunch of stuff within his realm of trading. It's like, okay, I don't like breaker blocks or rejection blocks or mitigation blocks. I don't like none of that. I just like order blocks and fair value gaps. I'm talking from like true experience. I only like order blocks and fair value gaps. That's the simplest stuff for me to spot. They're very strong, and I like those. I'm going to double down on that. Boom, double down on that. And another thing I hate is daily bias. I'm not good at daily bias. So I have another way to filter and find daily bias for myself, right? Boom, that's something you should do. If you're not good at daily bias, find alternative ways to be good at deciding where you should buy or sell, pretty much. Have another way to funnel that when you should buy or should possibly sell. Think of another way, right? Say you don't like market structure shift entry patterns because you get mixed signals sometimes. Okay, add a confluence. You could either use the inversely correlated pair of the pair you're trading, or you could try a different entry technique. Stuff like that. Just like those tiny little those little tidbits that's in your strategy. Tweak those, work on those, make those better. That's basically what this part of what I'm saying is tweak and revise things that don't work. All right, by that point, you should kind of have like a nice strategy in play. You should kind of have yourself at a decent point of pretty much being almost profitable. You should be taking challenges at this point and actually trying to earn yourself some extra funding, right? All right. At this point, this is what's going to make you like profitable, right? Honing in and actually mastering your edge. By the 3, 4, probably even 5 if you're a late learner year mark. Sorry, I thought I saw a spider. No, we good. By the 3, 4, 5 year mark, you should have a feel of what works, what don't work. You should have things tweaked and revised. And you should be able to hone in on what you know for a fact you like, right? Like, I knew by year 3 I was an ICT style trader. Then I kind of had to figure out what I like. I love fair value gaps and order blocks. I'm like, okay, I like this. Now I had to find a way to fix my daily bias. I fixed that. I found a strong confluence for the order blocks. Now I trade ICT order blocks based on the midnight and 8:30 open, right? The true day opens, and I use an order block to support price going up if it's in a discount, or selling if it's a premium. So I just split it into a premium and discount for the day. And I trade I trade order blocks that use displacement or imbalances above them that suggest they're strong order blocks to give me great setups. Because then I already got my confluences met. We're in a premium, meaning we're looking for sales anyway. We get an order block formed in a premium. That means it's a bearish PD array. Then we get priced to run into that and give me a sell signal as well inside of it. That's like 3 or 4 confluences right there. Then for extra confluence, what I was telling you guys earlier in the video, I go to check the inversely correlated pair of that. On that pair, it's buying. So I'm like, oh yes, I have like 4 things telling me this is sell. By that point, you should feel confident. You should be like, yo, this is a strong sell. Let's do this. You know, like your trades should tell you, okay, let's do this. If this loses, I always tell people when it comes to certain trades, you want to be baffled by losses. Like that's how good you want your strategy to be. Like when you trade your strategy, you want to feel like it'll always work. That's how good your strategy should be. That's how good and in tune you should be with your strat and with the market. Is like when you trade, you should be like, dang, I lost. This looked perfect. Why would I lose here? That's how you should be feeling and everything like that. But that's the order I would learn day trading in 2025. If I had to start completely from scratch, I would learn about the market sessions, which would play into me learning about market structure and the phases of the market, which would then play into me learning and testing different styles, learning and choosing different pairs, sharpening my psychology and risk management to push myself to that next phase of getting towards profitability by having a feel for what works, doubling down on what works, and what confluences I like the most, and then going back and tweaking and revising the things that I realized weren't the best things for this strategy. And then by that point, just doubling down and really hammering and getting the nicks and crannies out of the strategy and really hone in and master what I've truly found to have been my edge the whole time. All right. With that being said, I hope y'all enjoyed this video. I hope this video helps somebody else, anybody that's trying to learn how to trade, or like just trying to learn from scratch or anything like that. If it does help you guys, please leave a like. I'd appreciate it. And sub up. Y'all have a good one.